Hello everyone, we are back with Anthony Clark from Smalltalkdaily. It's a privilege today. We'll be looking at his top 5 JSE stock picks for 2022. He issued them earlier this year. They've done really well so far. So we'll just look at these 5 companies and updates on them. Anthony, so thanks so much for being here. Over to you.
Yeah, hi Hugo. It's really good to be back. And I hope your listeners gained some insight as to what's been going on so far this year. The market as a whole this year has been a very quiet start. Looking this morning, the JSE Small Cap Index is only up 0.15% year to date, where the Mid Cap Index is down just under 1%, showing you that the froth we had last year has come to a bit of a close. Not to say that there isn't any activity going on in the small to mid cap space, there is, but I think it's very, very selective. And as I wrote at the beginning of this year to my clients, I expected 2022 to be one more of a special situation stock pickers market. You couldn't just buy the whole basket and hope for the best. So I think going forward this year, if you want to make money, you have to be in a very specific basket of stocks. For that reason, for my top 5 of 2022, I chose a very diverse range of companies. Something for everybody. At the end of the day, I predominantly service an institutional client base. So they only want big blue chips which they can actually trade in and out of. But saying that, for a product like a top 5, there has to be some speculative stocks and smaller stocks which catch the imagination of not just the fund managers, but also perhaps the private client market. So in no specific order, I'll just read them out. So I had eMedia, which owns ETV. We all know ETV. I chose Invicta Holdings, which is an industrial holdings company involved in the mining, industrial, and supply of spare parts. Then there's Renogen, which is a stock that your listeners know extremely well, and to which I went to the site visit with them on last Friday. Then there's Sap Cap, which is basically a small investment holding company, been around for many, many years, which has done fantastically well. And then last there's a small platinum stock called Sizwe. Now, I don't specifically cover resources stocks, although I got a top rating last year in the small to mid cap resources sector. But there was a specific issue with Sizwe, which I thought was undervalued. As it stands of today, the entire basket of 5 is up just around 20%. And as I said to you, the indices year to date are basically flat. Now, I'm not saying that these 5 will continue to perform 20% a month until the end of the year. But so far, the underlying fundamentals, which led me to choose each of the 5, has clearly demonstrated that it's going in the right timeline. So let's start with eMedia. Now, eMedia, for those that don't know the company, is 80% owned by a black empowerment company called Hoskins Consolidated Investments, HCI. Their main assets are actually in the gaming and hotel industries. They own Grand West Casino, they own Soho Sun Hotels, and they're mainly into gambling and hotels. But they also have a media arm called ETV, which started many years ago and was loss-making for years. Now, last year, I went to an AGM, and I keep telling anyone that wants to listen, but if you don't go to an annual general meeting of a company, you are missing out. And I was the only analyst at the HCI AGM where all their underlying assets gave a presentation, and eMedia was compelling. After nearly a decade of losses, they showed in their first half a huge swing in profits, up over 6,000%, with earnings per share of around 28 cents in the first half, and a dividend of 22 cents. And the share price was trading at just under 4 rand. Annualizing that, given that the underlying advertising market in this country is recovering after the COVID lockdown, and people are spending once again in trying to get consumers to buy things, I'm anticipating ETV to have a very, very good full year. But most importantly, the parent company HCI wants dividends. eMedia is a cash cow. So they pay a big fat dividend this year. On a 4 rand share price when I chose it, you would have got a 10% dividend yield. So the stock is very, very illiquid. At the end of the day, you don't always buy a stock just for capital gain. You can also buy it for a dividend flow. And I bought eMedia, one, for a potential re-rating in due course, and secondly, for a very strong dividend flow, because that's what the parent company wants. And year to date, the stock's only up 3%, but it's still early days. I think it only tends to move on actual news, and the next news will be forthcoming results. The second stock that I chose was Invicta Holdings. As I have my coffee. Very well-known industrial company, owned by Christo Visa. I call it is a company that supplies widgets. If something breaks down in some form of capital machinery, you need a new spare part or a fan belt or a filter or a nut or a bolt, you go to Invicta because they have a huge warehouse full of bits and pieces to keep industries of Africa basically operating. If a conveyor belt breaks, if a track from a caterpillar breaks, they can supply you. This company, when I first picked it up 22 years ago, was a darling of the stock market. It reached a high of 161 Rand. And then a few years ago, due to a combination of very poor management and a large tax assessment by SARS, hit a low in COVID 2020 of 3 Rand 68, showing you how far the company had fallen from 160 Rand to 3 Rand 68. As it stands today, we're trading at 30 Rand 60 cents, which is a big bounce from where it was a year and a half ago. And I recommended the stock as a purchase in April 2020 at 6 Rand. It's done rather well. So why am I still picking the stock, given it's gone from 3 Rand 68 to 30 Rand 60 cents? Because one, it's trading at a discount to net asset value. Secondly, the company is debt-free. Thirdly, it's done some very, very strategic transactions in the last 6 months regarding acquisitions. One was in November last year buying a company called Dotcom, which is involved in fiber optic technology and rolling out technology in that space to not just a private individual, but to business. And it bought its main supplier of spare parts in January in the UK called KB, which takes it into the European and the US market. So it basically now can operate globally, and it increases its Rand hedge contribution. On Invicta's case, the SARS issue really weighed on the share price. That's now gone. The company at one point was 2.7 billion Rand in debt. As we stand today, it has zero debt. New management is in place, and there's a sense of energy and invigoration around the company. And I think the company at 30 Rand 60 cents has had a great year, given the Hudeco trading update and results that came out last week, which showed a really solid set of growth metrics. And at the end of the day, the market always misses out on the obvious. And I'll give you a perfect example. About 2 months ago, the Motus share price, which is involved in motor retailing, had a hell of a run. It ran from about 99 Rand to about 120. But the CMH share price, Combined Motor Holdings, went nowhere. And I thought, well, hang on, if this company in this automotive sector is doing quite well, why isn't its direct immediate competitor not doing as well? So I went out on a strong buy with CMH. And the share price last week ran very, very hard on a really fantastic trading update. I believe that Invicta is going to follow Hudeco. That Hudeco had a really fantastic trading update and a very strong set of results. And at some point, Invicta, as a March reporting period, will have to come out with the same, and the stock will have a run. And I've got a target price of a short term of 35 Rand, and after that, it'll probably get to between 45 and 50. Hence, Invicta remains a buy. More coffee. Renogen, a stock that I tipped at the beginning of the year at 33 Rand. As of this morning, it hit a high of 42 Rand on the back of a site visit that was conducted last Friday by Steph Marani, where a number of private individuals, institutional analysts, and myself went along to see the current state of the Virginia Phase 1 development. Now, Renogen, at its low point about 2 months ago, hit about 29 Rand. It had reached a high in the old run of about 41 Rand. And then things never go up in a straight line. You always pull back about 1/3 of the gain that you've had. So I was expecting Renogen share price back in the day to fall from 41 Rand to about 30 Rand. It exactly did. At 30 Rand, I re-established positions, and we're now back to 42. Now, again, things do not go up in a straight line. The underlying conditions and fundamentals around Renogen have changed since my last recommendation. Things do look better. The hot commissioning is actually occurring. The taps will be turned in April, and the company is very far down the line in raising money to actually fund Virginia Phase 2, which will cost between 12 and 13 billion Rand, which is roughly 3 times the current share price or the current market value. So do not be surprised if some form of innovative funding scheme, albeit an offshore listing, a strategic investor, or some form of other transaction happens in the next few months to secure funding for Virginia Phase 2, and the taps will turn on that project on or around 2025. Now, from the site visit, it was quite clear from what management was saying that the total cost of Renogen's Virginia Phase 1 and Virginia Phase 2 will be in round numbers, between 14 and 15 billion rand. But they estimate that they should produce profits on the complete evaluation and commissioning of a project at full capacity of around 3 billion rand a year. So that sounds like quite a compelling little argument, but there's a long way to get there first. There's capital, there is timelines, and we need to get the equipment. So I would not be banking on this stock continuing its heady run north of 50, 60, 70, 80. But I think the wind is in its sails. I think the stock clearly has additional momentum above and beyond what took it to the last high of 41 rand. But I would expect in the short to medium term some form of natural correction. You cannot have a stock going up from 30 rand to 42 without some form of natural pullback. So I remain fairly optimistic and positive on the stock, but also very cognizant that we've had a very strong rally, and that strong rally does have better fundamentals than the last one, but there has to be some form of pullback. So I would urge shareholders currently to be fairly cautious and not to be too aggressive in chasing the share price at 42. Things are different, but things never go up in a straight line. So I would happily be keeping an eye on the stock, but not chasing it from here. Then we have Sap Cap, which is run by an extremely well-known business entrepreneur called Christopher Seabrook, with a 30-year track record of managing companies. He's been on the board of Massmart, Data Tech, Altron, and he's a very well-regarded entrepreneur in his own right. So what Sap Cap is, in layman's term, is it's a family wealth office. So basically, Christopher Seabrook is an extremely wealthy businessman. So he created a company to manage his own family money. And he allowed individuals like you and I to actually buy into that vehicle. So our wealth is tied in with his wealth. So if he does well, we do well. So my view on Sap Cap is you are buying into a business where the owner and operator of a company has got all of his family money in the same vehicle as you. He's not going to do anything to erode or denude that capital base. He just wants to grow net asset value and add new assets that will actually increase the underlying valuation of a company. The current net asset value is around 3.5 billion rand, and the current market value is about 2.5 billion rand. So trading at a nice discount to net asset value. The company has been buying back shares and recently made two strategic new investments. One, it bought a 20.36% stake in the electrical wholesaling and industrial fitments company ARB Holdings. And indirectly, because of another investment it has in a private equity company, it ended up owning 44% of the Ascendis medical devices business, which it acquired. So all in all, it's been doing some very strategic transactions. Net asset value as I stand right now is at 88 rand 58 cents. I think that'll be about 90 rand when results come out fairly shortly. And the current share price is at 61. So you can see there's a very large inherent discount to net asset value. It is my belief that as the year rumbles on and the last remnants of COVID work its way through the system, but a couple of Sap Cap's very, very large assets involved in the international garments, trimmings, and labels business will start to recover, and there'll be a very large re-rating of the net asset value of those companies. And I can see net asset value of Sap Cap going through 110 rand by the end of this year. Now, at 110 rand and a 61 rand share price, you can see where the potential of this company lies in share buybacks, deal flow, re-ratings, and net asset value uplift. And at 61 rand, I can easily see the share price in the 80s or early 90s by the end of this year. Then my last stock was a completely speculative stock, was called Sizwe, involved in the platinum belt. I chose a stock at 112 cents. It's now at 169. It's up 50% in the year so far, in the first 5 weeks of the year. Why did I choose Sizwe? A combination of reasons. One, because the platinum sector last year had a number of interesting transactions. You had Impala, Northam fighting over Royal Bafokeng. The share prices were doing quite well because of the potential impact of PGMs on electric vehicles and power cells, etc., etc. But more importantly, with Sizwe, for the last 10 years, has spent a lot of money getting a plant up and running. We are now at a point where the company turned from a massive loss to basically a break-even situation in the last 6 months. It is now moving into operational viability and starting to produce between 200,000 and 300,000 ounces of platinum a year at some of the lowest cost operations, given it's a brand new site. The important thing here is November last year, a very key piece of data was released called the Competence Persons Report, called a CPR. That's produced by an independent body which certifies that what is going on has been true and correct, and that the underlying production of PGMs and the potential value of those PGMs, what could accrue to Sizwe. And that Competence Persons Report came out valuing Sizwe at between 8 and 10 Rand a share. And at the time of the report, it was trading at less than a Rand. So you do the mathematics. Even if you put a huge discount to that CPR, pick any number, 50%, 60%, 70%, at a Rand, Sizwe was still trading at a massive discount to its valuation. And I put a buy in the stock, and it's now trading at 1 Rand 69. So those are my top 5. Year to date, we're up about 20%, versus the index, which is basically flat. And I'm very confident to own those 5 stocks for the rest of the year.
Very, very interesting. Thanks so much for that. So there's some questions on that. This is an interesting one. From those 5 companies, if you had to buy from those 5 stocks, which stocks of those would you own for 5 to 10 years if you had to pick some of them? And
okay, as it stands right now, because I have mainly an institutional base, I have to be quite cognizant of the volatility, the value uplift, and of course the liquidity of a stock. So of those 5, I would be very happy to own Sap Cap, Renogen, and Invicta on a 5-year view. One, because they all are sizable companies trading between, call it 3 and 4 billion Rand. They have liquidity, and they have inherent underlying prospects. Granted, Renogen is a different case because it's moved from a speculative exploration company towards a commercial operating entity, but it still has significant demand for capital to fund its Virginia Phase 2. Sap Cap is an investment holding vehicle where you're basically buying a portfolio of assets at a significant discount to its net asset value. So as management actually starts adding value to those investments, there will be a natural uplift in the underlying net asset value and thus the share price. Invicta, it's a huge recovery play. With new management been in charge for the last 2 years under the astute leadership of Stephen Joffe, debt has vanished. The company is now in a much stronger position. It's doing deals, and there's a new energy around the business. I would not be surprised that on a 5-year view, that Invicta once again starts to trade at a significant premium to its net asset value. I told you in the previous segment that at one point it was trading at 160 Rand, which was a huge premium to its net asset value. We're now trading at a discount to net asset value. And I would not be surprised if in a 12 to 18 month view, I can see Invicta at 60 Rand. So if you were to ask me on a 5-year view, and I hate giving predictions because I'm not a fortune teller, and it's not in my scenario. But I would say that if you were to buy Invicta, Renogen, and Sap Cap on a 5-year view, you would substantially outperform the mid-cap index.
Very interesting. I also love Renogen. As you know, we've interviewed the CEO a few times. We'll put the link in the description for those interviews. Invicta is also, from what you're saying, it's really intriguing me that there's no debt and the new management, because obviously when a company has no debt, it's always a one tick in the right boxes. So it's very interesting. Thank you so much. If for those watching, thanks for watching again. Go check out the previous interviews we had with Anthony Clark. You can follow me on Twitter. We'll put his handle in the description. Have a great day. Thank you so much, Anthony, for your loads of knowledge. We'll have you back definitely soon.
Thank you.